And I figured this would just be an easier way to get information out to you guys. So apologize, it took me a few months to kind of get back on track with this, but I really want to start sending kind of the newsletters out on a monthly basis and include a quick video for everybody as well. So if you have any insights, any questions or anything like that, feel free to shoot them our way. But let's get started. Just quick slide showing credentials, 17 years in the securities industry, and then just all of contact information as well. So here's kind of the quick market stats. I don't know how much everybody's kind of been paying attention to what's been going on. It's been a tough year in the market thus far for both equities and bonds, but more so for bonds because they typically aren't a very volatile asset class, and people utilize bonds really to work as a little bit of a buffer to market volatility and for just more stable income, more stable investments. And the bond market's gotten hit really hard, down about 8.5% year to date, which is one of the largest drawdowns in the history of the bond market. Investment grade bonds are down 12.5%. 20-year treasuries are down 18%. The rise in interest rates and really how quickly the rise in interest rates happened really put a lot of downward pressure on the bond market. So it's been a really challenging environment from that aspect. And then the equity markets have struggled too. The S&P is down about 8%, NASDAQ's down almost 15%. Emerging markets are struggling as well. Market breadth, anybody who's really, had conversations with me regarding the market over the past, really the past year, market breadth has been an issue for really since February 2021. Ever since kind of the end of February, market breadth really started to dry up. Inflation is clearly a major concern. I think surprises in that area. Anybody who goes to fill up their car or goes to the grocery store is definitely feeling the pinch right now. Russia-Ukraine situation, again, no surprise there. Obviously weighing on the markets. Interest rate uncertainty just based on because they need to raise interest rates to try to control inflation, but the market's not really in the best spot. So it puts the Fed in a little bit of a corner in terms of how to manage that situation. The argument can be made that the housing market is overheated. And then we're coming into some seasonal weakness too. The summer months are typically a little bit more volatile. And can show some more issues in addition to the fact that we're in the second year of a presidential year two in the presidential term, which is usually not great for the market as well. So all that stuff kind of combined is weighing down on the markets right now, both the equity and the bond market. I've shown this chart. I don't think I've shown this for maybe like 2 years now, but really talks about the really large days in the market, whether it's up or down, typically coincide during bear markets, right? So if you see these big swing days, even if it's an up day, like if the market's up 3.5%, 4 or 5%, something like that, it's not always a great thing because it usually does coincide with time periods where the market's also down those kind of same amounts around those time periods, right? So volatility works in both directions. So if the VIX is really elevated, volatility is really elevated, then sure, you may see a day where the market's up, 3.5%, 4%, but it's probably going to be followed by a day where it's, down 5%. And so you can kind of see, the S&P 500, the largest percent gain since 1987 and the largest percent decline since 1987. And I color coded, right? So you can see that all these, really big up days happen, during, bear markets. So you don't want to see, really volatile environment, even to the upside when it comes to investing. You really just doesn't bode well for the investment strategy. So really, volatility now has subsided recently. It hasn't, it was much higher in January and February, but we still want to see it come down. The Russia-Ukraine situation. This is just a quick chart showing the, S&P 500 in the, kind of its response to geopolitical events. And just saying, hey, obviously not a surprise that with, a war going on, that the equity markets are struggling a little bit. Some of the, the wars that have happened, affect the markets a little bit more. Some of them not so much. So we'll see. I don't think that everything that's going on in the market is based off of the Russia-Ukraine situation. I think when, there's some other things that are pulling the markets down and making it, a little bit on thin ice right now. So this is the top chart here. The S&P 500 is on the top. The bottom is just a 1 period rate of change, right? And so it's really looking at kind of the daily range for the rate of change on the range of the S&P 500. And you can see, right, when those bands widen, those, again, like I was talking a few slides ago, those really large days, both to the upside and the downside, coincide with bear markets. This is 2008 financial crisis. This is when the U.S. debt got downgraded. The market corrected by about 22%. This time period, I didn't even highlight this one, but 15 and 16, two corrections here of about between 12.5% and 15%, and then obviously the COVID crash here. We have seen, right, this has started to get a little bit wider here on both sides. Nothing too drastic yet, but something to pay attention to, right? We don't want that to turn into a situation like this, or obviously like 2008 either. So we want to see the daily rate of change really subside and get smaller, like here in 2017, 2014 as well. So just want to, continue to monitor that situation and really want to see that those dispersions not get any bigger than they kind of, especially how they were in January and February. Looking at volatility again here. You've got the VIX on the bottom, the VIX, the volatility, 30-day expected volatility is in black. The S&P 500 is on the top. Again, the VIX it's still high from, from a historical aspect, right? We're still sitting in that 20-21 range. Really want to see it get down lower into the mid-teens or even lower. That'd be great. But it's still in that situation where it wouldn't take much for it to spike close to 30. And once it gets in that area, that's when you see, these shaded areas where the VIX is spiked over 30 and showing positive momentum. So we really want to try to avoid that. And hopefully volatility just completely subsides. I don't think that'll happen, especially with all the stuff going on. But that's something that we want to see to kind of get that all clear, like, hey, everything's fine. But we'll see moving forward. Credit spreads. So this is kind of I would say the nail in the coffin that would say, hey, things are really, really rough out here. Now this is high yield spreads, actually triple C or below. So like junk of junk. And I like this. I like these spreads to look at just from a price sensitivity aspect, but it's been trending up, right? It's been trending up since kind of the fourth quarter of 2021, but it hasn't had that huge jump yet. And so again, if you look at it, right, here's the dot-com bubble, here's 2008, US debt got downgraded, kind of the, I would say an earnings, recession, 15 and 16, COVID, right? And so we haven't jumped up yet on this. This is the thing I think to pay the most attention to, that if you see credit spreads widen and spike drastically, then it is really kind of a really, really rough situation. And, things could get bad pretty quick. So this is something to really pay attention to. And this is the bottom line is the chart from the previous slide. On the bottom there is credit spreads. On the top is the S&P 500. And then, the shaded areas there are anytime credit spreads are over 14 and showing positive momentum. And you can see that it coincides, really well with when we go through major drawdowns in the equity markets and or recessions. So really pay attention to that. It's, every week when I go through the data, that's like the one I'm always curious to see where they ended up for the week. For the most part, I kind of know where a lot of the other things fall because I watch them on a daily basis, but credit spreads I look at once a week. And I'm always curious. And they haven't spiked up yet. So that's a really, really good sign. This is a chart, relative comparison chart between two different ETFs. SPHB is a high beta. Beta really has to do with volatility. So it's really looking at the most volatile stocks in the S&P 500. So SPHB is the 100 stocks with the highest beta. SPLV is an ETF which has the 100 lowest beta stocks in the ETF. I believe the ETFs are reconstituted I think it's each quarter. And it really shows what you want to see in a healthy market environment is the high beta stocks outperforming low beta. So you're being rewarded for taking on the additional volatility is really what that would be showing. And so if you look at the time periods where low beta is outperforming, right? So if this is a relative comparison. So we're taking high beta, dividing it by low beta. So if the line is going up, high beta is outperforming low beta. If this line is going down, low beta is outperforming high beta. All right. They both could be going up. They both could be going down. It's just showing which one is outperforming the other. So in this particular case, so right here, line's going down, right? So low beta outperforming high beta. Okay. And this is 2011. So the US debt got downgraded. Market corrected by about 22%. Right here, low beta outperforming high beta. Again, 15 and 16, kind of an earnings recession. The market corrected by about 12.5% in August, and then had I think it was like a 14% correction in the first 45 days of 2016. And then you've got the fourth quarter 2018, low beta outperforming high beta. Obviously, COVID. And then here we are here. It kind of plateaued back in February of last year. That's where I kept talking about where market breadth kind of dried out at the beginning of last year. A little bit of a sideways chop, and then it's fallen off not off a cliff here yet, but it's definitely fallen. Low beta has definitely outperformed high beta over the past 4 months or so. And so again, something to pay attention to, that if you see credit spread spike and you see low beta really outperform high beta, which is you would see if credit spread spiked, then we're probably in a really rough water situation. So something to pay attention to again. Really want to see high beta, get some momentum back on its side. And it just hasn't really happened. It happened in the month of March a little bit. I think the last 3 weeks of March. But it just hasn't been able to sustain that momentum. So this is looking at volatility in the equity markets versus the bond market. So everybody talks about the VIX. That's the green line on top. That's the expected 30-day volatility in the equity markets. And then there's also basically a VIX for the bond markets. It's called the MOVE, MOVE, right? That's on the bottom. And so what we're looking at here is the VIX on top. And where I said it was a little bit elevated, it's not crazy yet, right? It's not anywhere at like 28 or 30 or higher. But it, is, from a historical perspective, a little bit high. The MOVE, right? So the volatility of the bond market is the lower line. I mean, we're at, historical almost levels here. I mean, you don't see bond volatility spike like you did, other than, again, this is COVID, so that's, understandable, but it just doesn't have these kind of moves like it's had. And so it's really shown that the market expects more continued volatility in the bond market right now. That could subside, but that's just kind of where we're at today. And so we look at, again, the MOVE here is on the bottom. So the black line here is the volatility in the bond market. You can see, again, this MOVE here, right? The top line is AGG. AGG is the Barclays Bond Aggregate. It's like the S&P 500, but for the bond market, right? It's kind of the proxy for the bond market. And you can see as volatility, and this makes sense, right? As volatility spiked here, bond prices, AGG got absolutely, hammered this year so far. So we really want to see the MOVE, kind of subside and momentum kind of slow down the volatility for the bond market. It all really has to do with interest rates. And interest rates have everything to do with the Fed trying to control inflation right now. So hopefully the inflationary data has peaked or is close to peaking, and the Fed doesn't have to be as active in raising interest rates. They're in a tough spot because the equity markets aren't on the strongest footing right now. So really difficult situation for them. So this is the 10-year note, right? So everybody talks about where's the 10-year, and that has to do with where, mortgage rates are going to fall and things like that. It's going back to like the, mid 60s, just showing really where we've been. I mean, this is where obviously probably a lot of people listen to this, bought a house back in the early 80s. And it's always interesting talking to them and saying, oh yeah, they, their interest rate was 15%, 16% and stuff like that. And so it's, it is kind of, funny now talking to people, and, people have interest rates of, 4.5% or 5%, and they think that's high. And not historically, but the problem is, real estate prices are significantly more inflated than they were back then as well. So, but this is just showing the environment we've been in since the early 80s has been a falling interest rate environment. So obviously it's had its spikes from time to time, but it's been a falling interest rate environment. And that is what has, really made this move in interest rates, the spike up. That the severity of it has just, spooked investors quite a bit in wondering, hey, are we in a new paradigm here? This is the chart from before, just since the mid 80s. I just drew two channel lines there showing that, really traded inside this channel for about, 40 years or so. And, we broke out a little bit in 18, and we really broke out here. And so is this a new paradigm? Are we going to be in a rising interest rate environment for the next, 5 years, 10 years, 20 years, whatever? Or is this a short-term blip, right? I don't think we can be in a rising interest rate environment for a sustained period of time because of the debt that the country has. That makes it really, really challenging. So I don't necessarily think that's a case, but it is putting pressure on the markets today. And that's really what we're focused on, right? So we really want to see, we don't want to see interest rates go up too high, too fast. It's not necessarily that, interest rates at, 4% or 5% are really, really high. It's the severity, the rate of change that they happen to, do that at. That's what one of the concerns is. And can the economy handle it? And that's one of the concerns and one of the issues going on right now. This is, I talked about the drawdowns in the bond market. This is LQD and investment grade bonds ETF. LQD is down 12.5% year to date. This is the move in LQD. I mean, this is the COVID crash, right? I mean, that was huge. LQD, I think it was 20%. It happened in like 2 weeks. But this is right. This is this year. I mean, that's a severe move. This is 2008. I mean, so you're looking at one of the larger drawdowns in investment grade bonds in the history of that market. And you look at, here's TLT. It's a 20-year plus treasury ETF. One of the largest drawdowns ever. I mean, it's down 18% year to date. I mean, it just absolutely brutal move. I mean, and that's just year to date. If you look at, I mean, it was 170, 172, 173 back in, I think that's like March or April of last year. And I mean, it's down to 123. I mean, just enormous downside move to TLT. Based on the rise in interest rates and just how fast those moved. So really challenging environment in certain areas of the market. Looking at inflation. So tips are inflationary protected treasuries, dividing that by TLT. So looking at is the bond market favoring and pricing in more inflationary data. And if you're seeing this line go up, right, then tips are outperforming long-term treasuries. And yeah, it is. And I do some momentum oscillators there on the bottom. And yeah, I mean, the market's still pricing in some inflationary data, especially for the bond market. So, really want to see that change course as well. RINF. It's just an inflationary expectations ETF. It's 30-year tips divided by treasury spread. And yeah, massive rally recently here. Another just momentum indicator out there, oscillator on the bottom. Another massive rally here. And this is really just inflation expectations, right? To the ETF, you can buy. And it's, if you think inflation is going to continue to rise, this is something you could look to own. It's pretty volatile, so you got to make sure that you can stomach that. But yeah, so still pricing in some some upside momentum here. It was a little overbought, but again, really want to see inflationary data peak. That would be really helpful. Oil prices, not a surprise. Anybody goes to the pump right now, and you're spending anywhere from $60 to $100 to fill up your car, right? So oil prices still elevated. That's had a historical correlation to recessions, so that's certainly on the table when you talk about $100 oil, or hey, could it get to 130, 140, 150? It puts a lot of pressure on the global economy, and so if we continue to see oil prices rise, that's gonna continue to put tilt the odds of a recession happening a little bit higher. Now when people talk about a recession, it doesn't, not every recession is like 2008, right? So anytime people talk about a recession, I think recency bias kind of comes into play, and everybody just automatically assumes, hey, the global economy is going to come to a screeching halt. Not every recession is like that, and so it's not to say that we could have a recession and that the market might be able to handle it okay. That does happen. There have been recessions where the economy, or the stock market was okay during that time period. It's not beneficial. It's not necessarily what you want, but not every recession ends up in a 50% drawdown in the S&P 500. But it certainly could. That's always a possibility. I'm not suggesting that we are going to see a 50% drawdown. Just saying that with everything going on, especially the spiking oil and inflationary data and interest rates and the Russia-Ukraine situation, there's just a lot to keep your eye on. And so we really want to see some of this stuff turn the corner, kind of go the other way. And oil would be great if we could get back down to like, $70 or $80 a barrel oil. So we'll see what happens with that. XLU utilities, they've had a big run. And utilities typically, no, not always, but they typically fall into that defensive category. So if you see the stock market going down and utilities going up, that's not necessarily what you want to see. It's showing that, the defensive, again, like I was showing earlier, those high beta versus low beta, right? Utilities are, the low beta assets typically are going to be a little bit more defensive in nature. Utilities more defensive in nature, and so we're seeing work right now. Utilities, gold, metals, commodities. Some commodities, oil specifically. All that stuff. A lot of those can be defensive in nature. Oil, not necessarily. It's a whole different. Commodities are a whole different ballgame. But utilities, low beta, healthcare. Consumer staples, that's what's performing best right now. And that's what we own the most of for our advisory accounts that we manage. And so we, just kind of showing this is, utilities divided by the S&P 500. So again, if the line is going up, utilities are outperforming. If the line's going down, the S&P 500 is outperforming utilities. And we've seen here, right, since kind of late last year, this big spike where utilities have really started to outperform the S&P 500. So if this continues to spike up, that's not a good thing. You would want to see the other sectors in the S&P 500 outperforming utilities to feel really, really comfortable with the direction that we're going in. Not really what you want to see. And then here's gold, right? Gold, gold can be a defensive asset in nature at times. It's not always, but metals are currently performing pretty well right now. And gold's pretty close to breaking out to another all-time high here. So, again, I think just, people don't really have a tremendous amount of faith in equities right now, and certainly not in bonds right now with the interest rate spike. So some of the assets I've been talking about, low beta, consumer staples, utilities, gold, all performing much better. So really don't want to see these trends sustain for a very long period of time. This is disclosure at the end here, all the states that we're registered in. Take a minute and read through that. Let me know if you guys have any questions or anything else, any other charts, anything you'd want to see on anything, any of the future videos. Certainly can incorporate those. So thanks everybody for listening. And I hope you're all doing great.